morning, ladies and gentlemen. Welcome to Business Day Television. This is Shail Bhatnagar. Continuing with our coverage of top quality third quarter earnings, we are now focusing on KPIT Technologies. The stock is in top shape, up 71 rupees at 1442 rupees. This is a 5.2% gain on very strong volumes. And the reason behind that is, of course, this very strong third quarter performance that KPIT has come up with. Let me just brief you with the numbers. Net profit rose 21% year on year at 187 crores. Sales rose 18% at 1478 crores in the quarter gone by. A very strong pipeline is what the company has described that. And joining us from KPIT Technologies is Mr. Sachin Tikekar, Joint MD and co-founder of KPIT Technologies, and Priya Hardikar, CFO of KPIT. Good morning to you both and a very warm welcome. I'll start my conversation with the lady first. Priya, how do you explain this year-on-year rise in profit? What were the driving forces? And at the same time, why is profit dipping sequentially?
So if we look at, I'll first take the growth in our revenues. If we look at, we have mentioned that we have a very strong relationship with our top 25 client, the strategic client. The relationship goes on strengthening further. If we look at our existing pipeline, which we have mentioned that during the quarter, we have closed $236 million worth deal. I think that is the most confidence boosting thing about our relationship with our clients. Apart from that, if we look at our cash conversion or we look at pipeline, I think both put together demonstrate a very strong relationship with our clients, and therefore we are confident that we can bag more wallet share from the ER&D spend that all of our clients do. And therefore positive that in the current fiscal year, we will reiterate our revenue guidance and also improve the profitability. Now, looking at your second question, why the profit has dipped from previous quarter to current quarter. If you look at the results in the previous quarter, we have declared a one-time gain or an exceptional income of 45 crores minus tax, that is around 32 crores. That is mainly because of one of the insurance claims that we had received of the previous period. But if you remove the exceptional income, you will see that our sequential PAT, that is profit after tax growth, is 5%. So 187 should be compared to a sustainable number there, and therefore from that perspective, there is a profit improvement. I think our operating margins are also improving. We are very confident that our revenue growth will also funnel the productivity improvement. We are investing in the right aspects of our business, whether it is AI or competency building. That is boosting our confidence to also improve the EBITDA margin, if that explains both of your questions.
Absolutely. Let's get Sachin into the conversation and try and find out how the subsequent quarters look ahead. Sachin, a very warm welcome to you. And there has been a mild increase in the guidance that you've given. Please walk us through what clients and customers are telling you, especially amongst the top 10, and what prompts you to tweak this guidance upwards for the coming quarters.
Okay, so let me first talk about the guidance has been increased on the EBITDA side. So from 20.5% for the year, we are saying we will be at least 21%. That gives us essentially what has happened is the business mix has changed. What I mean by that is we are providing more and more solutions. There is a little bit more of licensing that we are doing in terms of revenue. So there are some non-linear revenues. And last but not the least, the productivity gains, especially on the back of all the investments that we have made in artificial intelligence and so forth. So these are the reasons why we feel more confident about our EBITDA for the year, and hence we have upgraded the guidance. Now, coming to your question about what are the conversations look like with our clients and how do we really look at next few quarters. So first of all, let me talk about the the closures, the actual engagement closures this quarter has been in excess of 20% as compared to the last one. So, which is great news for KPIT and all the stakeholders of KPIT. Second part is the pipeline also continues to look very strong, stronger than ever before. So these are the two reasons that gives us confidence that things will look up as we get into the early part of next year, especially the second half of next year. Now, in terms of the conversations with our clients, as you know, everybody's under tremendous pressure, especially in the last 2 quarters. If you look at the performance of all the global OEMs, it's been, to say, on the declining trend for the most part, to say the least. And I think everybody's trying to find out what they're sort of trying to figure out who their clients are, which markets they need to focus on, and so forth. At the same time, do all of this with greater efficiency in terms of the cost of the vehicles, the efficiency of the operations, and also bringing out new cutting-edge features that are required to meet the consumer demand. So I think they are all going through this thinking, and there is also a need for them to reduce their costs. Hence, some of them are actually thinking about consolidation of their partners, and KPIT being, just focused on passenger cars and trucks. It puts us in a pole position to have these meaningful conversations and hopefully create more longer-term kind of engagements with many of these clients. Some of them are existing clients. Most of them are existing clients. Some of them are new clients. So the conversations across are positive, but they're going to go through some iterations as they really figure out what all these changes, the pressure that is coming from China, pressure that is coming from all the geopolitical issues, what does that mean to them in the short term and the midterm? Hence, what kind of choices they have to make, right? And we'll go through that for another 1 or 2 quarters, but we remain very optimistic, Shail.
Right. For our viewers, ladies and gentlemen, let me just put this across. One of the finest software developers for the global car industry is what KPIT Technologies does. If you look at the track record of the company over the last 5 years, the stock has appreciated each year by 71% versus a 21% rise in the NSE IT index. So that is the kind of outperformance I am talking about. The 52-week high and low range is 1928 rupees was the all-time high, and for the moment the 52-week low is 1223. Let's take this conversation forward, Sachin, in terms of what your clients are telling you. Of course, Europe and US are in terrible pain. They are your main markets. If you see the details of what you've offered, it says that both the US and Europe contracted, but there was a lot of good, how should I say, traction coming in from Asia. Europe and US are your main markets. What is your view forward when it comes to the next 5 or 7 quarters in terms of the US and European auto industry?
Well, absolutely. Let me take your questions one by one. So just to sort of look at what has actually happened. So bulk of the growth resulted, whether it's year-on-year growth or quarter-on-quarter growth across the geography, Asia has been the leader. Absolutely no doubt about it. I would just like to add that some of the business that we do for specific OEMs in Europe and US, when it's fully managed from India, it comes under Asia. So I would moderate the amount of growth that you see in Asia by 15 to 20%, because that actually belongs in some ways to the OEMs who are actually in Europe and the US. Just to put it out there. Having said that, we do believe that Asia will be our fastest growth driver in the midterm. And looking at next year, the pipeline as we speak, because that would lead to more conversions, it's the strongest in Europe right now, followed by Asia and the Americas. So next year we see more balanced growth coming our way across the three geographies. I think some of the long-term conversations that I talked about, these are with some of the car makers and truck makers in Europe, and also some of them are also about the conversations with some of the car makers and off-highway, specifically mining and agriculture OEMs in the US. So we do believe that next year you'll see balanced growth.
Okay, fine. Let's get Priya into the conversation. Ma'am, somewhere in early part of this financial year, you had mentioned that the company would be going for a QIP of 2,880 crore rupees. I believe that plan is now on hold, and there is a new, how should I say, plan in place. Now, first, what is that plan? And the original need for the QIP was for inorganic acquisitions. Does that still remain on your radar?
Yes, inorganic growth has always been one of our strong strategic initiative that we have done over the years. We continue to look for the right technology partners or the right people and right companies to work with that share the same passion as we are in the mobility industry. So inorganic growth will remain our focus area. What we have said is currently the outlook that we have and the plan that we have for the inorganic growth, we believe that we will do out of our existing internal accruals. You've seen our robust cash conversions during the quarter. So some of it will be from our own cash generation, and some of it we will also look at borrowing, because if you look at our current balance sheet, we don't have any debt on the balance sheet. So we will explore looking at debt option, borrowing option, along with our cash accruals. QIP per se, that what we had done was it was an enabling resolution only, so that if the need arises, things can be expedited and the execution also becomes a little seamless. What we see right now and the traction that we have on our inorganic growth, we believe that our internal accruals and some of borrowings can also be helpful. And therefore, it is on a, I should say, on a back burner.
Okay, fine. The reserves that I see are at about 2,229 crores. Is my number right?
Results for the quarter?
Reserves.
Can I read out the numbers
this
to you?
Is a number that I have for March 22. Yes, please do.
Should, yeah, so I think what we should look at are the numbers for the current quarter. The revenue growth is basically sequential YTD 20.7 and 17.4% in CC for quarterly. Net profit stands at 187 crores for the quarter, which is 20.4% YOY growth, and EBITDA for the current quarter stands at 21.1%, and therefore it is a 20.8% growth from the YOY perspective.
Priya, I think the question was specifically.
No, I was mentioning about cash reserves.
About cash reserves.
Cash reserves, yes. So for the current quarter, YTD December, the cash stands at 1,400 crores.
Okay, fine. Okay. Yeah? And how much are you earning on this cash?
So you can see from our other income, I think we have a decent amount invested. From the total cash that we have, more than 70% of the cash surplus is invested there based on our investment policy. And naturally, from our investments, our policy is mainly from safety, liquidity, and then lastly, it is return because, safety comes first. So from that perspective, our other income includes the income earned on 70% investable surplus from the cash.
Fine. Let's get Sachin into the conversation. With this amount of cash, Sachin, what are the targets that you have in mind? Are they geography specific or are they product specific?
When we look at, obviously, we look at the strategic sort of strategic fit from in terms of what we actually see. One of the things that that has helped us to remain in the forefront of the growth over the last 5 years, as you had mentioned earlier, is to look for trends ahead of time, make those investments upfront. Many of the investments are made on our own, where we build those offerings ahead of the demand. And sometimes we also look for offerings that will complement what we are doing. And sometimes they come through inorganic part. So usually when we look for inorganic growth, we actually look for something that will complement what we are doing. At the same time, will create a greater value for our clients. So when we look at it more from the offerings perspective, in terms of how can we really service the client, or sort of help the clients in a more comprehensive way. That's how we really look at the acquisitions. If you look at what are the areas where clients are, our global clients are likely to see, we all hear about the Chinese OEMs. They offer incredible features at 30 to 40% less cost. And that's something that the global OEMs outside of China have to deal with. That means some of their priorities are, number one, how do they reduce the cost of their vehicle? Number two, how do they offer the features that some of the Chinese OEMs are offering at a price point which is much lower? So given all of this, we are actually looking at targets that will sort of, in terms of the acquisitions, that will complement what we are trying to do, if that answers your question, Chair.
Fair point. I'll come to the Chinese OEMs a little later. I want to understand from Priya, how have margins improved? Is it because of, maybe lower hiring, or, more use of artificial intelligence? This is a bugbear within the tech community as to why the former pace of job creation is no longer there. Maybe you could shed some light on it, Priya. How have margins improved, and how is attrition, and how is headcount?
Right. As Mr. Tikekar mentioned in the beginning, our revenues are mainly now happening non-linear way. Some of the licensing deals also happen. So I think we are right now well poised to actually de-link the revenue and the headcount, because that is how we are improving our profitability as well. Improvement in profitability is threefold, Shell. First of all, utilization improvement and all the right things to do on the grassroots level with our team there. The second one is naturally, as you mentioned, the AI. The AI investments that we are doing are in mainly threefold. What we do for ourselves, whether it is for enabling function, how do we improve the productivity and cost efficiency for all of them. Secondly, how do we deliver to our clients? So in terms of delivery to our clients, we use mainly as our productivity tool, and therefore also gain significantly on the productivity there. This is the biggest lever for improvement in our margins. And lastly, what we also want to look at is what it can do in terms of our offerings to our clients. So AI will play a significant amount of role of enhancing and strengthening our offerings to our clients. Looking at all of this, we believe that we are well poised to reach our 21% plus EBITDA margin for the current fiscal. Naturally, as Sachin mentioned, we are ambitious. We want to grow, and with the the growth margins there will be one of the focus areas as we move forward.
So just to add to a couple of points from Priya's side,
Sachin,
that means, yeah, sorry.
Please. Yes, please do.
No, so I was just going to add to what Priya was saying about the headcount and the attrition.
Yes, I missed.
So on the headcount, we continue to hire. What has happened is we have made offers to many graduates who will be graduating in June, July. So we continue to hire people. It's just that the mix of people, the talent that we look for is going to be different in future than what has been in the past. I think we look for people who can think at a system level, people who can use AI more effectively and so forth, right? So the lens of talent has changed, and our attrition continues to be at the lowest level, not only for KPIT but at the at the industry level. I think what we are doing is very exciting for our employees as well as for our clients. So our ability to attract and retain talent has gone up substantially, not just in India, but across our footprint across the globe.
Yes, thank you, Sachin. I missed that.
Okay. Sachin, this question is aimed at you. How much of your revenue and business comes from China? There is a reason why I asked this.
Very small percentage of our current revenue comes from China. We've been in China, just so you know, we've been in China for more than 16 years. We are not new to China. And our business was actually growing quite a bit till about 2020 before we got hit by COVID. And then suddenly for 3 years, we couldn't go to China. So, sort of our China operations and the rest of the world got disconnected. And the business went down during those 3 years because we couldn't take a holistic view of China. So after that, now for the last year and a half, we are in the process of rebuilding our business. And what we realized during those 3 years that China, especially their car makers, have made substantial strides in terms of what they have to offer. That kind of took us by surprise in terms of, while people were sort of dealing with COVID and not able to visit China OEMs had done substantial amount of work in 3 years. And that not only took us by surprise, but it also took most of our global OEMs by surprise. So last year and a half, we have invested substantial amount of time in China. I personally spent several weeks in China just to learn what is happening. Secondly, our executive board team, we took them there last year. And this year, our leadership team of 35 people spent a week in China just to understand China innovation, China speed, and the kind of ecosystem that they have developed so that we can not only do business in China and make it viable, but also to learn from China and apply those learnings to make our global OEMs outside of China far more efficient, effective, and tech savvy. So that's what we've been doing in China. We have started some engagements in China with some of the local OEMs there. We have some global OEMs who have a footprint. We also help them. So we will see steady increase over the next several quarters in our business in China. However, we want to be a little bit cautious about it. It's almost becoming a divided world as you see the tariffs on the Chinese cars, not only in the US, but also in Europe and many other countries. Now there is a ban on software of Chinese cars in the US. So we just want to make sure that we do justice on both sides. So we are very keen to learn. We are very keen to develop our business, but we are not jumping in headfirst in China as yet.
Okay, so the veritable bull in a China shop or a dragon in the China shop, only time will tell. But given the latest numbers that are coming in from the global car OEMs, China is going to play a very, very big role from the already big role that it plays. Thank you, Sachin and Priya, for joining us for this excellent conversation. Here's wishing you all the best. Happy hunting with the cash reserves that you have. And looking forward for the next quarter for this kind of performance once again. Thank you for your time.
It was our pleasure. Thanks for being patient with us, Shell. And nice talking to you.
Thank you, Shell. Have a great day.
Okay. An equal pleasure.
Bye.
Okay. You too. This, ladies and gentlemen, was the top team of KPIT Technologies, CFO Priya Hardikar and co-founder Sachin Tikekar were talking to us for the quarter gone by and, of course, the outlook ahead. KPIT is still up about 5.5% at 1441, and that's because of the stunning year-on-year rise in sales and top line. Thank you for watching. Please continue with Business Today Television. There's a lot happening on the other side of the break.